Oh, hi class. We again are back on management accounts, and today we're looking at P3. I have to say I am really excited because P3 is the most difficult question to answer in terms of management accounts. And we have our expert today, Shavita. Thank you very much for being here today. The whole class and all the students are so grateful as a qualified chartered accountant to explain this eloquently and diligently. So I'll leave you to look at the question. I'll just read the question first, and then you can break this question down for us. So the question says to calculate costs using appropriate techniques of cost analysis and prepare an income statement using marginal and absorption costs. I'll just say that one more time. Calculate costs using appropriate techniques of cost analysis to prepare an income statement using marginal and absorption costs. Where do we start?
Right, if we break down the question and we look at the keywords, we are doing some calculations. We'll be playing with the numbers.
Yes.
Because we have to prepare an income statement. And
Right.
if we define it that way, we say income statement is like a profit and loss account.
Yes.
But if you look at, again, like in B1, we said there is a difference between the financial statements and the management accounting statements. And the difference here is we are not looking at how much profit we have generated from the past activities. Here we are looking at if I'm launching a new product in the market and I got the budgeted figures in place, is that figure, is that product gonna give me profits in future or not? Should I go ahead with the profit of the figures or not? So that's what we are looking at the management accounting. So we'll be definitely looking at calculating the figures, we'll be putting them in the income statement, and we'll be learning two different methods of calculating that profit and loss account using marginal costing and absorption costing.
Okay, so that's clearer for me. So what you're saying is that we actually have to make some calculations.
Yes.
We have to put something in an income statement.
Yes.
And just to refresh people's minds, an income statement are your sales minus your cost of goods sold.
Absolutely.
Gives you your gross profit.
Absolutely.
Then you take away your administration charges, gives you your net profit,
and that's
and
it,
then
what we're looking at.
and so
that's it. Up to if you're looking at Excel level 4, it is up to that level we are looking for.
So we're not looking at the retained earnings side,
No.
which is also part of the income statement.
Not in this question.
So we're looking at two different methods. So this is really good because we're saying, okay, what are two different ways of calculating the income statement using either marginal costing or absorption costing?
Yes. So we'll start looking at the basic knowledge that's required to understand this question, and we'll be looking at different classification of the costs. If you look at the diagram, it clearly says that they are not different to each other. There's some common element as well. So starting with the first kind is the manufacturing and non-manufacturing, and that, as the name clearly states, that those costs which are associated with the manufacturing of the product gets into manufacturing, which are not related to manufacturing costs, they are non-manufacturing. For example, if you look at manufacturing, your raw material, your direct labor, that comes into your manufacturing. Any factory overheads, that's manufacturing. When you look at non-manufacturing sides, your marketing, your admin, your finance, that all goes into your non-manufacturing. So that's one way of classifying the costs.
Which costs are we looking at there?
We'll be looking at all of them.
Yes.
When we'll be looking at the marginal and absorption costing.
Okay.
So it's good to have a basic understanding of 6 types
Manufacturing the actual product itself, or the lights, electricity to make that product,
Yes.
and all the other things that's not part of it, like the marketing, sales, administration.
Absolutely.
Okay.
They all goes into non-finance, non-manufacturing. Then the next category is variable costs and fixed costs. Again, the cost that you can associate directly with the production. So if the production goes up and the cost goes up as well, that's your variable cost. So if there is a production, then this cost occurs. So variable cost varies with the production, that's why it's known as variable. For example, your raw material, you're producing 1 packet of biscuit, you need a raw material for that. You produce 2 packet, you got more material for that, and as the production goes up, material goes up. That's variable. When you look at the fixed cost side, you are looking at the cost which you still incur if there is no production. For example, the rent for the building, the salary of the gatekeeper, even the building is empty, nobody is doing anything about it, still you are incurring the cost and it is not affected by the production. So that's your fixed cost. So that's another category we're looking at.
Yes.
And the final category is your product costs and the period cost. And this is the most important element if you really want to understand the difference between the marginal costing and absorption costing. So product costs, which are directly related to the product, you can associate it with the item itself. So if you're producing, like we just said last time, if you're producing a bridal gown,
Yes.
and any cost you can associate with that gown itself is a product cost. And if you can't associate with it, you can take it as a period cost, which is for the whole year,
Yes.
for 6 months.
Yes.
So it's depend upon how much period we are taking it to.
I have to say thank you for making that absolutely clear.
No
I mean, it's really good that you've got a manufacturing, fixed and variable, and a product
Product
cost.
cost,
It's
yes.
very, very clear for students.
Because once you got this knowledge, it makes life easy to understand what is marginal costing, what is absorption costing, and what is the basic difference between the two costs. So moving forward, like we've already talked about this, so it says, when you look at the marginal and absorption costing, this is the basic assumption being made for the variable and the fixed cost. And it says the fixed costs remain the same irrespective of the production volume. This is assumption because in real life it might not be the same case. But when you are dealing with such situation where you're making the income statement using the methods, you have to keep these assumptions in mind. On the other hand, like we just said, that variable cost varies with the production volume and variable cost per unit remains the same. It means as the production goes up, variable cost goes up, but the cost per unit remains same.
So are you saying that the absorption costing is linked to the fixed and variable costs?
Both of them.
Okay, both of them.
Both
and
of
marginal.
them. Yes, both of them are linked to this.
Yes.
But the way we treat variable and fixed cost into methods, that's different.
Okay.
And that's the only difference.
Okay.
So how we're treating them is the matter of question.
And you're going to show us that later.
Absolutely. We're going to talk about that.
I'm going ahead of the game.
No, that's fine. I think it's coming out of the curiosity. So, just to clearly understand like what we said about the variable and the fixed cost, because that's really, really important to understand. What we are trying to do here is, we got two volume levels of production and we got total manufacturing costs, which includes your variable cost and the fixed cost. And the question is asking you here, can you tell me how much of this is variable and how much of this is fixed? So you literally have to calculate and separate the variable cost from the fixed cost. And that's what we're going to work on. But how we're going to work on is based on these assumptions.
Yes.
So we have to keep in mind that fixed cost is always fixed, no
Yes.
matter what is the production.
Yes.
But the variable cost varies when the production goes up.
Yes.
So it means if we go with that assumption, we can say the difference between these two costs is literally the variable cost. Because the fixed cost in 1000 units is going to be same the fixed cost as in the 1800 units.
Yes.
So if we take a difference of this, and if I take a difference of this, I would say in producing 800 extra units, I have incurred $200,000 of extra cost. But that cost is just variable cost. There is no element of fixed because we are relating it to the increase in the production.
Yes.
And that is only the thing we have to understand here. So if we look at the solution to this, we said that in 1800 units, we have incurred 600,000. For 1000 units, we have incurred 400,000. If we take the difference, it's 200,000,
Yes.
and that's 200,000 is used to produce the 800 extra units.
Yes.
If I divide them together, I got variable cost per unit.
It's $250 per unit.
Yes, so it's $250 per unit, but this is only the variable cost.
So as long as you've got the two quantities with the amount increase,
Yes.
and you've got both the costs, you take one cost away from the other
Yes.
to give you the difference,
Yes.
and that's the variable cost,
Yes.
and then you divide that by the number of units, which gives you the various unit cost.
Absolutely, absolutely. Now, as we looked at the assumptions and we said this is variable cost because that varies with the production. So if $250 per unit, $250 is the per unit variable cost, what do you think is the cost for 1,000 units? It's going to be 250 times 1,000,
Yes.
which will give you the total variable cost.
Yes.
So if this is the total variable cost of your 250,000
Yes.
and your total cost was 400,000, if you take out your variable cost out of the total cost, your balance should be your
Yes.
fixed cost.
Now, I have to be honest with you. You
Yes.
just lost me slightly there.
Yes.
I'm up to you until the 1,800 units minus 1,000 units, and I've got up to the 200,000 divided by 800 units gives
Yes.
£250,
Absolutely.
$250. But then, explain the last bit, the next bit with the $250.
I'm just going to do that because we'll come back to here
Yes.
where we'll have the question. I'm going to put something on the
Yes.
board to make it more clear to you. And it says, we got this, right? We are happy with $250,
Yes.
which is per unit,
Per unit. Yes.
and it's a variable cost.
Yes.
We're happy with that,
Yes.
right? Now, if I go back to here and I say, if this is for 1 unit and I have produced 1,000 units,
Yes.
how much is the variable cost I have incurred? And I would say 1,000 units
Yes.
times